Welcome everyone. This is our annual MLG market update. It's fun doing this every year. We kind of drill back into what's happening in the marketplace. But before we dive into that, it's always great to reflect on how blessed we are to have the talent we have at MLG, all the clients that trust us and rely on us to do great work. And I'm so thankful to have the team here today. I got Billy Fox, president of MLG Capital, and Dan Price, our chief investment officer of MLG Capital. And it's a blessing to work with these guys, and our whole team is just, we just have such a deep team of talent. A lot of people spend a lot of time and effort to put all this information together for us to share with you today. And hopefully you'll get a lot out of it. We certainly do when we put this information together. So let's get into it. I'd like to open up a little bit and give some background, and just so we talk about this internally. But frankly, the market that we've been through the last couple of years is the excess supply delivery market, building more product than the market really needs. And this is the first time we had an excess supply market in roughly 40 years. I mean, the last time we had the excess supply was in the mid 80s. I started as a young guy, underwriting deals back in the late 80s myself. And so we're back again. And these are rare. This doesn't happen often, but it's hard to manage through that. So Dan, we have all this excess supply. We're dealing with the reality of that, creates opportunities as well. But let's dive in a little bit to the operational side. And what are you seeing, and what would you like to share for all of our clients?
Yeah, thanks for kicking it off, Tim. And I'm going to start with 2 points too that I think kind of set the stage. One is the core message really hasn't changed much from our market view in this conversation we had last year, which I don't think is surprising, but it's important. And supply takes time to get through, and we're getting through it, but it takes time, and it's submarket by submarket, market by market. And we're going to talk very macro. That's how we usually talk in this conversation, but we're definitely going to hit, because you have to, about some of the challenges more regionally, or submarket by submarket that we're seeing. The second thing I would mention too is, when I talk to most investors or, clients or friends out there, they always ask me, how's the real estate market? How's MLG doing? And it's a good question, but the real question should be, where and in what product type? And I think that really leads us then into my conversation and discussion on operations and supply. We're going to talk macro, but you have to talk micro in what we do. And we take that responsibility, right? We're going to look at the macro trends and figure out, why we like things for the long term. But we have to talk about the near term and the short term. And that leads us into the supply conversation. So we've been hitting that conversation for a couple of years now. And it's definitely, heightened focus right now. We saw peak deliveries, like you mentioned, right? Over 600,000 units delivered in 2024. And that was a result of low interest rates, lower costs, and people were putting, shovels in the ground and delivering lots of supply that hit in 2024. But those deals were starting in 21 and 22. And each year, right? If you look forward to 2025, it's come down to 400 or 1,000 or so units. And you look into the next 3-4 years, it's going down substantially. So when you think about and look at where the supply is, though, that's the next important piece to talk about. 75% of that new supply is in the Sun Belt and the Mountain West states. It's where you saw population growth, job growth. That's where developers go build housing, right? Those are the metrics they chase. But everybody chased it, and that's where all the supply has been. So when you start looking at asset performance and, property performance, the lower population growth markets are where we're seeing the steadiest, stable, and positive rent growth, tighter occupancies, which is very counterintuitive in general to where, a lot of people look to invest or build. So when you look at MLG's portfolio, our Sunbelt portfolio has lower occupancies, and the Midwest portfolio or lower supply areas have much higher occupancies and are seeing positive rent growth. And I think the last piece, just from an operational and supply perspective, is we always watch construction starts and permits, right? That's what leads to new deliveries. And those are falling off a cliff. And it's the same conversation we had last year. But what this means is that if construction starts are down to roughly 50,000 units a quarter, roughly 200,000 a year, that is way below the long-term need for housing in this country.
Let's pivot a little bit and talk about just from broad perspective. How has that impacted the capital markets? How has that impacted the interest in private real estate investing? What are you seeing from your role in chasing real estate?
Yeah, it's very fluid, and it's similar to the story we said last year, and probably even in back in 2023 and 24 when we were raising and deploying Fund 6, right? The conversation was beat the herd before capital flows back into real estate, right? When interest rates went up substantially, a lot of folks left the real estate space or didn't look to make new investments. 2023 and 2024 saw significantly reduced sales volumes across all sectors, right? Capital was cautious. And there's a big portion of the equity market out there, specifically from institutional capital, right, that has not come back to the market yet. But 2025 did see, a bounce back. We're a little bit above 2024 volumes. So it's 1 to 2% or so above the 2024 transaction volumes in the multifamily world. Industrial, we saw actually a much larger uptick in capital flows and sales volumes in 2025. But if you're going to invest in private real estate today and you're going to do it in scale, institutional capital is looking at multifamily and industrial because they can scale and make significant investment in their portfolio. And we think it's just a matter of time before that capital comes back.
Yeah. So I look at that and I hear you talk about it. I mean, ultimately, if there has been less demand for private real estate, you're seeing higher cap rates. And we are seeing that starting to stabilize out now as more capital is coming back into the marketplace. I actually think it's kind of interesting. There's a lot of capital that went to debt funds and away from real estate. And you're seeing some challenges in that space, which may create some more demand for private real estate. Plus, with the stock market run and an increase of that, they have more capital flow in the real estate way because of capital allocation models and having money in each asset class. So it's interesting. I think capital markets are going to shift from wind back towards real estate. So it'll be exciting in the weeks and months ahead. So ultimately, any other final comments you want to make, like on the outlook of the market? Is because we're going to start diving in a little deeper here into the detail. Any other broader outlooks, perspectives that you have?
Yeah, I would add that historically we've talked a lot about market softness in the Sun Belt and what that means from a lower occupancy, lower or sometimes declining rents, concessions. A part of our strategy is still to buy into that softness, and the upside as things stabilize can be really compelling. But we've also made a concerted effort to buy very stable cash flow for our funds and our investors throughout the Midwest. And we've done that with more multifamily Midwest acquisitions and industrial acquisitions that have traded higher cap rates, but have seen very good rent growth. So it's a blend of both, but we're very focused on steady, stable cash flow. And that's been a big focus this year.
Yeah, and I'd say a simple way to describe it is we're buying soft EBITDAs, operational numbers that are soft, lower, and the multiple on earnings are lower. So therefore, it's a really interesting time to be a buyer in the marketplace. Let's pivot and let's dive into the availability of debt and equity.
I'll kick things off here on the equity side. This is one of the charts that makes me most bullish today. We present here the last 5 years of data as it relates to capital inflows in non-traded REIT vehicles. This includes some of the largest blue chip REITs in the marketplace. Some names certainly you would recognize. And what they show, and Stanger Investment Banking puts this data out, what it shows is in that second column of fundraising in 21 and 22, you see peak fundraising in the $33 to $34 billion range annually. If you look at years 23 through 2025, if you go to the net fundraising column all the way to the right, the second column from the right, you see net redemptions each of the last 3 years. When we talk about scarce equity being available, it's hard to capture that better than the data that's available in this slide. What we saw in Q1 2026 is trends to slightly above, call it mid 6 to 7 billion expected to be raised in these strategies annually, with certainly some expected redemptions again this year. Pretty early in the year to call or expect where things are going to shake out. but we are coming off a period of significant capital flows out of private real estate, making opportunities on the buy side today compelling because there is not the institutional capital available.
Dan, why don't you dive into some of the numbers behind what's actually happening in the debt availability of equity and debt?
Short story takeaway is that there is a lot of debt available. We've seen continued debt availability in the multifamily space, in large part through the agencies, Freddie Mac and Fannie Mae. They've actually increased their lending caps each 20% this year. So they're looking to do more volume this year. The banks are back in a big way. The banks were really not active the last couple of years, but kind of in mid 2025, they came back in a big way. So they're actively looking to lend. Life cos are active, CMBS is active, and then private credit has been really active, really has grown a lot, but there's some challenges there. So short story, there's a lot of debt availability today and at historically low spreads. So we're seeing, really competitive debt environment.
Billy and I are both CPAs here. We love talking taxes. So Billy, what are some tax considerations that we look at when doing our investing?
And Dan, even though you're not a CPA, we still love you too. But real estate is an incredibly tax advantaged asset class. And we work really hard to maximize those benefits and pass them through to our investor partners. And how we raise capital today is somewhat not in vogue. I would describe the non-traded REITs that provide some liquidity to their investor partners as gaining more attention from the private retail investor landscape, the investors we service. But to really deliver the best tax benefits to our investor partners, we feel like we need to invest their capital in an LLC structure where we can maximize depreciation deductions and pass them through to our investor partners. So anytime we go out and buy a property, we do a cost segregation study, which enables us to break the large asset down to its component pieces and depreciate those component pieces over shorter lives. And the One Big Beautiful Bill Act enhanced our ability to depreciate more early in the life of an investment. So if you invested $1 million in Fund 7 last year, you would have received $660,000 of rental loss allocation. Not all investors can use that.
Hey, it's just paper losses.
Paper losses from these outsized depreciation deductions. Not every investor can use these right away, but they are a real asset to reduce future income tax at the highest rates for our investor partners. And that our investor partners receive that benefit. Depreciation deduction simply cannot flow through a REIT vehicle. We actually have a complementary REIT vehicle for our investor partners that do like to invest qualified account money, but there's significant capital out there that wants to realize these tax benefits and still wants to participate in a diversified fund structure, modest leverage, and we can offer that in Fund 7, which is exciting. So we work really hard to maximize these tax benefits. On top of that, we have our legacy fund strategy, which enables investors with highly appreciated real estate, with low basis, low debt, where they often want to be relieved from the burden of managing that. They want to simplify and enhance their estate plan, pass that wealth on to their heirs in a way they're not going to force them to have to manage property or debate about the value of the property if one heir may be interested in buying out that partner or other heir from that investment. So taxes are a key piece or structures rather are a key piece of how we deploy our investor capital. We are incredibly thoughtful and diligent in terms of how we structure all of our investments to achieve the best after-tax cash flow.
Billy, Dan, thanks for all the effort and putting all this information together to educate our viewing audience here. It's fun doing it. I get fired up seeing the numbers and it gets me excited about investing more myself. So any other comments, Billy or Dan?
I just say so grateful for those who've entrusted their capital with us. We work hard to protect and grow that every day. We are passionate about what we do. We dig into the macro to the micro. We're eager to share what we do with you. And thank you again for listening today, for your investments with us.